So, Shri, I know that you don't agree with 100% of what Jim's been talking about. So what I'd like you to do, if you could, is, again, keeping in mind that the title of the series, to talk about some of the different tools that the Fed could use, where you disagree, what you really think has been going on, what you think the Fed should be doing in the future. And then also, I think it's important to, and John, you jump in as well, to give a context of the Fed versus some of the other central banks globally and how you could be targeting the repo rate, for example, if you were, a different, so, but that's mostly for context and EM. So please, with no further ado.
Very good. And again, Stacey, I'm going to be, some of those may come through like as if they are assertions, even though I'm talking about the mechanics of finance.
Yeah.
So if it's not clear enough, or if I don't mention the channel, please do interrupt me and ask a question. I'm trying to cover a lot of ground, but without going into details in each case.
Understood.
To begin with, again, as both John and Jim said so well, the mandate of the Fed is in terms of improving employment and output, which one goal. Second is to maintain inflation at a manageable level, which generally agreed to be around 2% level. Those are the two goals. But as early as 2009, I started saying the Fed was going to be unsuccessful in its quantitative easing procedure. What I was not prepared for was the fact that even after more than 4 years of quantitative easing and lack of sustainable economic growth and lack of improvement on the job creation scene, that the Fed would persist with it. That's what I didn't expect in 2009. My expectation that the economy wouldn't respond has essentially come true. Let's see what the mechanics are and why that happened. There was a great piece in the Wall Street Journal by a lady called Anna Jacobson Schwartz in 2009. She was the co-author with Milton Friedman of a much heralded monetary history of the United States going back to 1860. And what Anna Schwartz said in 2009 is there is a basic difference between what happened in 1931-32 when the Federal Reserve was blamed for making the recession even deeper, making it into a depression by withdrawing liquidity from the banks. So the credits fell off and the recession became deeper and then eventually got to be called the Great Depression. The difference today is it is not in the liability side of the banks, the liquidity is being created in big sums. But as Jim pointed out, and it's a very important point, the monetary base has increased, but M2, the broader definition of money, has not. The reason being the money is sitting with the banks, $1.5 to $2 trillion worth. Who benefits from increasing the monetary base if it doesn't go out into credit and go into the economy? The Anna Schwartz argument was now you have a problem on the asset side of the balance sheet of the banking system as opposed to the liability side, which is where the problem was in the early 1930s. The Fed essentially misunderstood the nature of the problem as it began in 2009. And just as they did not foresee the financial crisis of 2008, they overestimated the economic reaction that would come from the quantitative easing process.
Now, Shri, I was wondering, could you explain what you mean by the asset side and the liability side?
Essentially, the liability side is, let's make believe that $100 of new cash is created and the Federal Reserve is created, and let's assume for a second there is only one commercial bank, that will be JP Morgan Chase. And so immediately what happens is they have $100 of cash which they are holding on the asset side. On the other side of the balance sheet, they also owe the $100, so it always matches. Now, if you withdraw, this is what happened in the 1930s, the $100 became reduced to $70 or $60. The Fed took away that cash, and therefore there was no possibility. The assets also had to go down, the banks had to lend less, and the economy suffered. The difference today is that 100 is not being reduced to 70, the 100 is being increased to 150 or 200. Actually, it's now quintupled from $800 billion in September 2008. Late, just before Christmas, we hit $4 trillion, quintupled during that time. It is mostly sitting in the bank's balance sheet because the banks can't decide who to lend it to. And on the excess reserves, they are being paid an interest rate. They can lend to the US government, to Uncle Sam, quite somewhere in the neighborhood of 3%. So why take a risk and go and lend to the private sector? So that's the difference between the 1930s and today, the difference between the liability side focus and the asset side focus that is taking place. The second point is, how do the mechanics work in terms of stimulating the economy? The cash that is created should be lent to consumers, to firms which are going to be using for investment purposes. But as one chart shows, slide 16 for instance, US private capital formation has not picked up in terms of the overall presence here. It has remained low because just the very presence of excess reserves in the hands of the banks does nothing to promote capital formation. The second way it is supposed to work and is through the consumers. The consumers have more cash in their pocket, and rather than hold on to it, they will spend it, they will stimulate it. It's the Keynesian multiplier mechanism. I spend $1, you get to keep 20 cents which you're going to save, and you spend another 80 cents of it. Somebody else gets your 80 cents, that person saves 20% of it, and so on. So we create a lot more income out of that one single dollar that was created. The difference now is that the consumers were so badly beat up by 2008 and 2009, the so-called wealth effect, which Chairman Bernanke heralded ever since from 2009, and my fundamental belief was there was going to be no wealth effect coming from the quantitative easing process, because the people benefiting were the highest income groups. And if you were low or moderate income, one, you either had been cut back sharply in terms of the losses you suffered in 2008, 2009, you didn't go back to enjoy the returns subsequently, or to the extent you did, it is no longer a significant part of your net worth. So many of those consumers did not participate, which is another reason why the consumer has not, over the last 5 years, been a big part of the stimulus program. Remember that in the United States, 70% of GDP is accounted for by consumer spending. So if you are not able to carry the consumer along with you, then it is not going to be a very successful way to meet. Now, we talked again about the two goals of the Federal Reserve, namely on the output and employment side and on the inflation side. Simply boosting stock prices is not a mandate of the Fed. But essentially, that is what it has turned out to be. The S&P 500 was at its low of 666 in March of 2009, almost tripled from those values. Last year, we had a 30% increase in stock prices alone. But then look at corporate earnings, even more so, look at the employment side, and that simply is not happening. The reason for that again is the lack of transmission mechanism that we talked about. Why did that happen? Why did that error take place? There is no precedent before late 2008 for quantitative easing in the United States. We do not know, we have no way of saying it's going to work. So essentially, it was a Hail Mary pass. Try. But the point here is, it was not as if it was the only reason given, and Chairman Bernanke has explained time and time again, fiscal policy is essentially gridlocked in Washington. We can't get anything done here. Therefore, we are the only saviors. It doesn't mean that when the headache persists constantly and you have tried all kinds of other medications, you don't shoot yourself in the head to cure the headache, which it will once and for all, but that's not a solution. And so here you are talking about a program saying, I am paid to be in the Federal Reserve, and I am going to increase the money supply because that's the only thing I'm supposed to do. I'm not working on fiscal policy, I'm not working elsewhere. So whatever I'm paid to do, I'm going to do it. Except monetary theory tells you time and time again, at very low interest rates that Jim showed in his chart, monetary policy is essentially ineffective over time, and it is not going to work this time either. The Fed then said, true, we know, we are all PhDs ourselves, we all studied the same economics, but we are going to do something because you have to do something. And what would that other something be? What would the mechanism have been to create employment? In my opinion, it would have been structural adjustments. Just like Abenomics in Japan has 3 arrows, supposedly: monetary growth, which is a big increase. I'll talk about Japan, Stacey, in a while. Fiscal policy stimulus, and third, structural reforms, increasing competition, increasing youth employment, and so on. Here again, you need a more flexible job market, reduction in entitlements, delay in terms of the retirement age. Those are various ways in which you improve the productivity, increase economic growth. Do we know that that will work? Look at Germany, 2003, and even 2003, 2005, Germany was known as the sick man of Europe. You wouldn't say that today, because the steps that they took starting in 2003 to make the labor market flexible, and I would maintain that today it is more flexible than the US market, definitely way more stable than the rest of the Eurozone and more flexible than the Eurozone, contributed to the economic growth. It's not monetary stimulus that does it. So the point I would make, I'll be back to you in a second, Stacey. The one point I would make is, if you are in the Federal Reserve and your responsibility is dealing with money supply, interest rates, quantitative easing, the proper thing to do would be, well, there is very little I can do. If you want to pay me, it's okay, but I'm going home. There is very little we can do in this economic context, which has to take place through structural changes. Sorry, Stacey.
No, I've heard the argument expressed by Jacob Frankel and others that, the structural adjustment is not within the Fed's mandate, obviously. So if the Fed is sort of the brass section of a band, and the band is playing on tune, the brass section knows what to do, and it's a very good brass section. But when the whole orchestra starts playing in a different pitch or in a different tune, what is the brass section to do? I mean, it can kind of play the score the way it knows it should, or it can join the orchestra and try to ameliorate effects on the edges to whatever extent it can in kind of a new decision-making paradigm.
You can try, but again, in the case of what the Fed is doing, Stacey, it's like saying, if you do have a cancer, and again, it was so serious in 2008, that is not something that a person who supplies painkillers the person can either keep quiet or do the same kind of prosaic work on a daily basis. The person has no solution. So my point to you there would be, again, the Jacob Frankel argument, and taking on what has happened elsewhere, is that it has not worked anywhere where you're talking in terms of monetary policy alone being used significantly to change the situation. So I would say under that setup, the Fed has nothing to do. So you can politically, you can put yourself as well as you can project yourself. Maybe it is not proper for you to say, I'm not going to do any work, but functionally there is very little that they can do. That's the point I think they will make. In terms of the other point here is what it has done in terms of people who are depending on zero interest rates, and which is what you get on the bank deposit. It has two pernicious effects. One is, as the US population has aged significantly, the graying of the population has accelerated from about 2007, 2008 till 2013. If you look at the number of people who are more than 65 years old as a percentage of the population, there's a significant increase in the last 5 years. And if I've turned 65, I'm 67, 68, I need a stable source of income, which I do not have anymore, especially on the fixed income side with interest rates close to zero. So what has the Fed made me do? A 69-year-old man who has about 20 years of life expectancy, 15 years of life expectancy, you say, I have to take the risk and go on to be in more risky assets. Now, this is the same Fed which had no compunction about the housing market in 2007 and 2008. Are you going to believe their forecast that you, a 69-year-old, should switch over to risky assets and your retirement is going to be well protected over the next 10 to 20 years? I wouldn't. The point being, I don't have an alternative. So very many people who are older, because they can't get the income, are shifted on, and the risk level that the consumers are forced to undertake is significantly greater. The second side of it is that the risk is increased as well. High yield bonds or junk bonds, the yield levels have come significantly lower like we haven't seen in many, many years. And until the Bernanke appearance before Congress on May 22nd, that was true of emerging market debt as well. It was clear that there was a lot of risk which was not being accounted for or fully taken into account, and we still don't know how that movie is going to play out in 2014 and 2015. The risk level has increased, and if tapering does happen, and I have doubts that the Fed is really going to taper, then you have to wonder how it is all going to fall out. The one other question which came out on the mechanics is, why is inflation so low? And again, I would agree that, as you said, Stacey, that it is very much a step function. It stays low. At some point, inflationary expectations pick up due to some trigger, some signal, you never know what it is, and as a result of it, there is going to be an acceleration in inflation. Yes, people who projected that immediately inflation would rise in 2009, 2010 were wrong, but that doesn't mean it is not going to happen. Just as people were forecasting economic problems in 2005, 2006, and there's Steve Roach, who was then at Morgan Stanley, and Raghu Rajan, who was then the chief economist for the IMF, and they were derided for their forecasts because they said these people don't understand how the economy is functioning, especially when the valedictory meeting of the Kansas Fed in August 2005 for Alan Greenspan, when nobody was expected to say anything negative about the overall situation. They didn't prove to be right in 06 or 07, but eventually they came right, and that's the risk in terms of saying you cannot time it properly, but the buildup of risk, I think, is very much being present. The last point I would make here is in terms of the tapering, and then I'll go on more on the international side. Just as I said that the Fed has no experience in terms of seeing the quantitative easing procedure in the past in terms of historical precedents, they have just reduced bond purchases in December, and they do not know what the fallout is going to be. Don't take my word. Bill Dudley, who's the president of the New York Fed and one of the permanent voting members of the Federal Open Market Committee, made a statement at the American Economic Association in Philadelphia about a couple of weeks ago that the fallout is still indeterminate. So do you walk in blind in terms of quantitative easing and increasing the bond purchases, and now you're going to walk out blind in terms of what the implications are? The last point in terms of the tapering here is that yes, the bond purchases were reduced from 85 billion a month to 75 billion a month at the December meeting, but I maintain it was a dovish move rather than a hawkish move on the part of the Fed, because even though the bond purchases were reduced, they said at the same time they were going to hold interest rates at a close to zero level for the federal funds rate for a much longer period of time. Why is that the case? The so-called forward guidance, which is supposed to be the way the Fed communicates, is essentially ended up being forward confusion. The various presidents and governors give open speeches contradicting each other, sometimes at the same hour or morning and afternoon. And if you are in the market, you don't know who to believe. One person wants to increase bond purchase, the other wants to reduce it. Why don't you earn the keep by giving your views in the closed door committee meetings rather than speak to the press on a regular basis? The transparency is not helpful. It actually increases market volatility and reduces people's desire for making investments. Going quickly on
let me stop you there, because I think we should give John and Jim maybe a chance to talk about, to respond just on the tapering point. I mean, one thing that you should know about the Fed is that on the 4-year, it will always raise rates. So in 94, this went very badly. In 2004, this went much better. And so the question is, how will it go down in 2014? And I think maybe talking about 94, the market still remembers the 90s when the Fed was when the market was completely taken by surprise. So it's trying to, anyway, John, I just want to give you a chance to respond to that.
Let me say just a couple of things. One thing is that the current circumstance is not only unprecedented for the Fed, but it's unprecedented worldwide. There's never been an advanced economy face the zero interest rate bound and handle it well. So we have the model of the Depression, where we think policy was pretty much a disaster. So that's not a roadmap. We have the example of Japan, where we think policy was far from acceptable, and that led to 20 years of misery. And we got no other examples. So the question is, do you do something that's been done before and known to be bad, or do you try to do better? And so we're trying to do better, but it's unprecedented. And I think that the chairman and others have been very clear that it's unprecedented. There's some good reasoning behind it, but it's unprecedented. The second is that Sri and Jim ended up giving the debate that is out there in the public. Sri gave the view that Jim said was the mistaken one that he wished didn't exist. It's going to be up to people like you to appraise those two views. They're both coherent views advocated by sensible people. But let me say one thing about that. We heard about Anna Schwartz, Milton Friedman's co-author. Milton Friedman was asked about quantitative easing in Japan, and he said, well, they're nuts. They're just raising reserves. Nobody could expect that to lead to anything good, as Sri said. What they should have done is buy long-term bonds. So Milton Friedman, one of the few things that he ever agreed with Keynesians on, he was the famous monetarist, was that in this situation, what you ought to try is buying long-term bonds, not because it leads to spending, as Jim said, and Sri said the Fed was looking for, but because it directly pushes down the rates on those bonds, and you push down the rates on those bonds, and things may happen. Now, good things may happen. Now, that's not a strong effect. It's not an effect that's been well explored. It's an unprecedented tool. But that's the thing we're going for. The Fed wasn't going for any of the stuff that didn't happen, and wasn't surprised that it didn't happen because that wasn't the intention. So then, but still, that's a good debate. So you have to listen to me, you have to listen to Jim, you have to listen to Sri, and we all think about it. We listen to Anna Schwartz and her co-author Milton Friedman, and we try and decide which of these is more likely to be true. And I think that's the main things I want to do say.
I should say one thing for you should know. Remember, the markets people are very forward-looking. We don't know what's going to be in the future, but we care what's going to happen in the future, so we have views about the future. So when you look at what happened this last year, the Fed finally started tapering in December. It was really not a big deal for the market. The big deal for the market happened last May, when the Fed hinted, when Ben Bernanke hinted they were going to be doing this. And that's a reminder that we're not sitting around blind to what's going on here until, we're constantly evaluating things just like the Fed is to figure out, is there something happening? Is the economy waking up? Will the Fed be forced to move the funds rate faster than they say? So that makes it more complicated because the market anticipates, if you're an investor, why do you want to own a long-term treasury security if you know the Fed's going to be out of the business of buying assets sometime in the next 3 years or 4 years? The second thing you need to be aware of, because in this debate that divides the different views, there's an implication that I think we tend to exaggerate the role of the Fed here. Because in this debate, there's an implication that there's nothing going on. The reason the stock prices are where they are is because the Fed's pumping it up. What you should know, connect the dots between this debate and the debate that's taking place about income distribution, both in Europe and in the US. Profit margins are off the charts. Profits are off the charts. Normally, after-tax profits are about 10% of GDP. It's been that way for 60 years. All of a sudden, in the last 15 years, they've moved to double. And one of the first things that happened in this recovery was the business community restored its profitability. That's what equity investors take their cue from. The second thing is there are things happening in the economy that's telling you it's coming alive. It may not be happening dramatically, but layoffs are back to normal, and every single state is seeing jobs increasing. Nationally, we recovered 85% of the jobs that were lost. So that's telling you this is the reason why the Fed is backing off, because they see the economy coming back. It's not like nothing's going on, and the only reason the stock market's reacting is because the Fed's sitting here buying assets. The market doesn't care that much about the Fed. I, as an investor, would not be buying stocks if I didn't see signs of recovery taking place, and the signs are really quite visible all over the place.
Just simply jobs report wasn't very good.
Oh, that's another topic.
But here's a question I have. the people at the Fed, they're not only monetary economists, they're economists. And why don't they speak up more that, and it's clear that they couldn't do it by themselves. Monetary policy, I agree with that.
That part I
They
agree
couldn't.
with.
So why
yeah.
don't
Yeah.
they, and when they testify before Congress,
Well, they do say
make
it.
the points about we need the fiscal side.
Ben Bernanke
Make
does
that
do
point
that.
as economists.
Ben Bernanke
In fact,
does say that.
So the
previous-
chairman does, but that's that's a matter. How strongly to do that is a matter of
Politics.
political economy, where the
Right.
Fed was made independent, and loosely speaking said, you do monetary policy and keep your mouth shut, and we'll take care of the other stuff. Was sort of the
Yeah, but
agreement.
they're economists, and they're
But they do.
The chairman
testifying in
has
Congress
said-
like economic issues.
And the chairman has said, we can't do it alone. We'd rather see a much better balance. We have to solve, it's been a constant mantra. We obviously have to solve some long-term issues of sustainability, but you'd like to do that in a way that doesn't do damage in the short run. Would rather see a better mix that has less
I didn't
negative
hear
effect
that.
in the short
I
run.
never
Oh,
heard
he
that.
says that every press
And
conference.
what they monumentally do not want is for the Treasury or the President to start telling the Fed what to do. You should raise,
No, I
you
didn't
should
say
lower
that.
your.
I'm saying that the Fed,
So you don't-
deal with the
Fed
devil.
economists should speak up about how difficult it is
Well,
for
so does the
monetary
chairman.
policy to be effective
So they-
in an
they-
environment like this, and you need help in raising aggregate demand.
So they have said that, but they don't.
Political process
Yeah,
is
my-
much more complicated than a central bank process, right? The central bank is monolithic, relatively. Political process requires the country get together, right?
My response is, if they are not, again, because of the political constraints, not able to advise the Treasury side of it, then don't do anything. Don't do something on the monetary side just because you're paid your salary to do something on the monetary side if it is ineffective. That's the point. The second one is, I take a somewhat different view from Jim, I think, on the economy side, that the economic growth has picked up. How do we know? It is as if you have had the screen of quantitative easing from late 2008 onward, with significant amount of bond purchases. We have no idea how the economy is going to do without it. So to those people who say that corporate earnings have picked up and the equity market has picked up, it is all a mirage which is because of the monetary influence there. And once it is removed, the jury is out as to what is really going to happen to the economy, to the stock market, and corporate earnings. And that uncertainty is heightened by the fact that we have a quintupling of the balance sheet of the Federal Reserve, that the unwinding is going to be more and more difficult in order to do that. And then again, the mechanics of it, the Fed's response is, we don't have to unwind, we can hold the bonds to maturity, really. If that in turn means that if at some point in time you want to affect the what's called the term structure of interest rates, what the interest rates are at different maturities of US Treasuries, and you want to increase, let's say, the 30-year yield in order to affect the mortgages, you decide that you're going to sell 30-year bonds into the market at that time to push the interest rate up, the response is going to be pretty vehement, because everybody knows there is a big cache of 30-year bonds sitting with the Federal Reserve, and so they are not able to function in that way they would have done had quantitative easing never taken place. So those are all the future issues. Somebody said to me the other day, why do you think Ben Bernanke is leaving at the end of January? I said, if you were Ben Bernanke, wouldn't you? So,
Well, on that we agree. Having done the job he's done for 8 years, it's amazing that he's lasted as well as he has, I think. But just one comment is once again, when you hear the argument that no one knows, et cetera, you just have to remember that no nation has ever successfully negotiated deflation like this. You either have the Great Depression or you have 20 years of malaise in Japan, and we're aspiring to do a little better. But if you're going to do better, you have to follow some unprecedented policies. You try and have them. We gave the reasoning. There's reasoning on the other side. Historians will look back and evaluate that reasoning, but it's the best reasoning. It's the best reasoning we've got right now. And but that's a lively debate that properly takes place on the FOMC, outside the FOMC, and in society and in rooms like this.
And Stacey, you wanted me to talk on the international,
A
the
little
global
bit, and
side.
by quarter past, if you could, because we want to give Robin a chance.
Yeah,
to-
sure. Yeah, no, I know that you have to leave as well. So I'll make it very brief on that.
Fabulous.
On the Japanese side, again, the Japanese program involves so-called three arrows of Prime Minister Abe, and those are one, that monetary expansion would be ramped up, fiscal policy would be, not much can be done because the debt to GDP ratio is about 240%. And third arrow is supposed to be structural changes, increasing competition in the Japanese economy, allowing for more employment of youth and so on. What happened? You guessed it. Monetary policy is the easiest thing to do. They have ramped up, and 1 month or the other, they are purchasing about 60 to 65 billion US dollars worth of bonds on a monthly basis. What's special about that? Japanese GDP is 1/3, so at about 6.5 trillion US dollars, compared with the US 17 or 18 trillion US dollars. And you're talking about an economy 1/3 the size, doing almost as much QE as the United States. What that means is that since the impact of it, people say, oh, haven't you seen the economic growth pick up and the stock market has rushed up? Yes, we know that. We saw that in 2009, 2010 in the United States as well. The question is whether it's sustainable. April 1st, they are going to increase the sales tax because they have to also play this game of reducing the fiscal deficit. And the fear is that the consumer would once again go into a funk and stop spending, and the economy then falls back into recession. They have tried this monetary policy game since 1991-92 at different times. It just hasn't worked. What needs to happen then? Very clear. The third arrow has already been set back. The Prime Minister says he cannot ask older Japanese to retire because it wouldn't be fair to them, and they need the job, they need the pay. What it means is that younger Japanese are not able to get jobs. That's one issue. The second issue is Japan is the oldest population in terms of the developed countries. 26% of the population is more than 65 years old. In the United States, that figure is 14%, China is 12%, India is 5%, Brazil is 7%. So much younger populations compared with Japan. Older people don't spend, and older people need more health care, they need more support, and that's why the fiscal deficit is going to stay high. How do you cure it? There are third and fourth generation Koreans in Japan who remain Koreans. They do not become Japanese citizens. If you imported 21-year-old people from neighboring countries, they increase productivity, they increase production. Will it happen in Japan? Not in my lifetime, maybe not in our children's lifetime either. In which case, you run the risk of saying by 2400, not quite a joke, there will be only one Japanese left standing. But you have to do something structural and change it. You can't play the monetary policy game. It just doesn't work under those circumstances. Going very quickly to give Robin the time on emerging markets, I think emerging markets have fallen victim of QE. The person who has spoken the most and very vigorously is Guido Manteca, the Brazilian finance minister, who has often talked about currency wars being done by the United States, which is an interesting issue. I'm going to set aside only because it's a totally big issue in itself, that the Fed probably has been supporting the QE as a means of debasing the dollar and getting some stimulus out of it. And many emerging markets are the victims because all this cash sloshes over and goes into Brazil, goes into other countries to find good interest returns, and inflationary expectations get boosted up as a result of the cash going forth. And the Bernanke defense of that was emerging markets should be supportive of US Federal Reserve QE because we are going to grow more rapidly. That means you countries can export more exports to us, and you should be beneficiaries of it. It just didn't happen because that's the way it happens, is that the cash first goes to those countries and boosts inflationary expectations, and it does not cause the exports to increase. May 22nd came and went, and you just have to look at the emerging market stock prices between May 22nd and September 18th, when the Fed met again and decided not to taper, and you saw how they had been whipsawed So much so that Raghuram Rajan, now the governor of the Reserve Bank of India, decided to postpone the Reserve Bank of India meeting by 2 days from that Wednesday the 18th to Friday the 20th, because they wanted to see what the Fed was going to do. What's the use of their running their monetary policy without knowing what the Fed was up to? So I think this is that if the tapering happens, then there is going to be one more hit against. Why wouldn't you have let the emerging markets grow because of productivity changes, because of employment growth, and their cost advantages, rather than try to help them out with an American QE, and then you withdraw it, and then it has the opposite effect. So perhaps in the interest of time, I'll just stop there, Stacey.
Okay, terrific.